Hey everybody, welcome back to Mortgage Madness. This week's episode is going to be about the 6 questions that you need to ask your originator before you get a mortgage. Here we go. First question you want to ask your loan originators: are they registered to originate mortgages in the state that you're residing? Not everyone can originate a mortgage. You have to be licensed with the National Mortgage Licensing System, or NMLS. Each originator and each originating company has to have their own number designated by the NMLS system. Mine can be found on my business card, and you can look up your loan originators at nmlsconsumeraccess.org. The second question you want to ask your loan originator is, what loan is best for me? Now, this can be different with everybody. What you want to assume is you want to have a very intimate conversation with your originator to choose which loan product would be best for you. There's a lot of different things that come into play here, and you want to have this discussion with your originator. Some of those things can inquire about your credit score, the loan amount that you desire, the source of down payment, where your down payment is going to be coming from, whether it's going to be a gift or it's cash that you have in your savings account, your mortgage payment comfortability level. If you feel comfortable with an $800 mortgage, you don't want a $1,000 mortgage because that's going to leave you house poor every month. And the MI requirements that are on each loan. Each loan has a different level of MI requirements, and you can play with the numbers a little bit with your originator to determine which mortgage process and which loan is going to be best for you. The third question you should ask your loan originator is, what paperwork is going to be required from me? Now, with every loan, there is some basic paperwork that you can gather. This includes your tax returns for the last 2 years, your pay stubs for the last 30 days, your bank statements for the last 60 days, and your W-2s for the tax years provided. Now, it's important to understand that the originator needs about 24 hours to look at this documentation and determine what other documentation that he would need from you. Now, it's on an as-needed basis, so not everybody's had a divorce in the past, not everybody's is receiving child support, so it's hard to give a detailed list until you look at that preliminary information. If you have a divorce, we'll need a copy of the divorce decree. If you're receiving child support or paying child support, we'll need to document that in the file as well. And if you've had a bankruptcy in the last 7 years, we're going to need your bankruptcy papers for the loan file as well. The fourth question you should ask your loan originator is, what is the estimated timeline for closing? The typical time frame can matter between 20 and 45 days, depending on how difficult the loan is, how good we documented the file up front, and how quick the turn times between you and I can be to make sure we cut out as many days as possible. The fifth question you want to ask your loan originator is, are you locking in my interest rate, and if so, for how long? Your general rule of thumb for locking interest rates are 30 days, 45, and 60. Depending on how long the loan process takes, you want to make sure that your interest rate is locked in. Now, you can choose to float your interest rate from when you take the application, but you do have to lock it in within 5 days of closing. The reason locking in your interest rate is a good idea is because you can guarantee that interest rate for the duration of the loan. Now, it is expensive to relock or extend a lock if you don't lock it in for long enough, so it's important to talk to your originator and get a good idea of how long you think the process is going to take for your loan, and make sure that you lock in your interest rate accordingly. The final question you want to ask your loan originator is, am I required to pay private mortgage insurance, or PMI? Your general rule of thumb is any down payment less than 20% is going to require some form of mortgage insurance. It's important to have this conversation with your loan originator so they can discuss with you which option is better. Some general rules of thumb is the higher your credit score, the less PMI you have to pay, and the more down payment that you provide, the less PMI you have to pay. So it's important to have that conversation with your originator to make sure that your finances are good after the purchase of the home, and also to eliminate the amount of PMI that you have to pay. Hey guys, wanted to thank you again for watching this week's episode of Mortgage Madness. Remember to comment below, let me know what you thought, give me some future ideas for next week's show. And remember guys, when you finance your house with Blake Duncan, it's a slam dunk. Thanks.